Hi guys. Welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about Forex trading and how to trade currency pairs. So make sure to watch the full video. All Forex trades involve the simultaneous purchase of one currency and sale of another, but the currency pair itself can be thought of as a single unit, an instrument that is bought or sold. When you buy a currency pair from a Forex broker, you buy the base currency and sell the quote currency. The foreign exchange market is where currencies are traded. This international market's most unique aspect is that it lacks a central marketplace. Instead, currency trading is conducted electronically over the counter, OTC. This means that all transactions occur via computer networks among traders worldwide, rather than on one centralized exchange. The FX market is the only truly continuous and non-stop trading market in the world. In the past, the Forex market was dominated by institutional firms and large banks, which acted on behalf of clients. But it has become more retail-oriented in recent years. Traders and investors of all sizes participate in it. Where is it? An interesting aspect of world Forex markets is that no physical buildings function as trading venues. Instead, it is a series of connected trading terminals and computer networks. Market participants are institutions, investment banks, commercial banks, and retail investors from around the world. Who trades on it? Currency trading was very difficult for individual investors until it made its way onto the internet. Most currency traders were large multinational corporations, hedge funds, or high net worth individuals, HNWIs, because Forex trading required a lot of capital. Commercial and investment banks still conduct most of the trading in Forex markets on behalf of their clients, but there are also opportunities for professional and individual investors to trade one currency against another. Types of markets. Forex is traded primarily via spot, forwards, and futures markets. The spot market is the largest of all three markets because it is the underlying asset on which forwards and futures markets are based. When people talk about the Forex market, they are usually referring to the spot market. The forwards and futures markets tend to be more popular with companies or financial firms that need to hedge their foreign exchange risks out to a specific future date. Spot market. The spot market is where currencies are bought and sold based on their trading price. That price is determined by supply and demand and is calculated based on several factors. A finalized deal on the spot market is known as a spot deal. It is a bilateral transaction in which one party delivers an agreed-upon currency amount to the counterparty and receives a specified amount of another currency at the agreed-upon exchange rate value. After a position is closed, it is settled in cash. Although the spot market is commonly known as one that deals with transactions in the present rather than in the future, these trades take 2 days to settle. Forwards and futures markets. A forward contract is a private agreement between two parties to buy a currency at a future date and a predetermined price in the OTC markets. In the forwards market, contracts are bought and sold OTC between two parties who determine the terms of the agreement between themselves. A futures contract is a standardized agreement between two parties to take delivery of a currency at a future date and a predetermined price. Futures trade on exchanges and not OTC. In the futures market, futures contracts are bought and sold based on a standard size and settlement date on public commodities markets, such as the Chicago Mercantile Exchange, CME. Futures contracts have specific details, including the number of units being traded, delivery and settlement dates, and minimum price increments that cannot be customized. The exchange acts as a counterparty to the trader, providing clearance and settlement services. Unlike the spot, forwards, and futures markets, the options market does not trade actual currencies. Instead, it deals in contracts that represent claims to a certain currency type, a specific price per unit, and a future date for settlement. Both types of contracts are binding and are typically settled for cash at the exchange in question upon expiry, although contracts can also be bought and sold before they expire. These markets can offer protection against risk when trading currencies. In addition to forwards and futures, options contracts are traded on specific currency pairs. Forex options give holders the right, but not the obligation, to enter into a Forex trade at a future date. Using the Forex markets, there are two distinct features of currencies as an asset class. You can earn the interest rate differential between two currencies. You can profit from changes in the exchange rate. So you can profit from the difference between two interest rates in two different economies by buying the currency with the higher interest rate and shorting the currency with the lower interest rate. For instance, before the 2008 financial crisis, shorting the Japanese yen, JPY, and buying British pounds, GBP, was common because the interest rate differential was substantial. This strategy is sometimes referred to as a carry trade. Forex for hedging. Companies doing business in foreign countries are at risk due to fluctuations in currency values when they buy or sell goods and services outside of their domestic market. Foreign exchange markets provide a way to hedge currency risk by fixing a rate at which the transaction will be completed. A trader can buy or sell currencies in the forward or swap markets in advance, which locks in an exchange rate. Locking in the exchange rate helps them reduce losses or increase gains, depending on which currency in a pair is strengthened or weakened. So, a trader anticipating price movement could short or long one of the currencies in a pair and take advantage of the movement. The most basic forms of Forex trades are long and short trades. In a long trade, the trader is betting that the currency price will increase and that they can profit from it. A short trade consists of a bet that the currency pair's price will decrease. Traders can also use trading strategies based on technical analysis, such as breakout and moving average, to fine-tune their approach to trading. A widely traded currency pair is the euro against the US dollar, or shown as EUR/USD. In fact, it is the most liquid currency pair in the world because it is the most heavily traded on. The quotation EUR/USD equals on 2500 means that 1 euro is exchanged for on 2500 US dollars. In this case, EUR is the base currency and USD is the quote currency, counter currency. This means that 1 euro can be exchanged for 1.25 US dollars. Another way of looking at this is that it will cost you $125 to buy 100 euros. There are as many currency pairs as there are currencies in the world. The total number of currency pairs that exist changes as currencies come and go. All currency pairs are categorized according to the volume that is traded on a daily basis for a pair. Currency pairs that are not associated with the US dollar are referred to as minor currencies or crosses. These pairs have slightly wider spreads and are not as liquid as the majors, but they are sufficiently liquid markets nonetheless. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.